The year-end rally in stocks continued into the first quarter, with the S&P 500 closing at an all-time high and posting its best start since 2019. It was encouraging to see a broadening out of performance, with the so-called Magnificent Seven representing about a third of the index's total return, down from closer to two-thirds of the index's return last year. History says that broadening out of index performance is a good sign of things to come. Why such a strong start to the year? Well, let's begin with the macroeconomic backdrop, where data released during the quarter continued to support the idea that the Fed is engineering a soft landing, cooling inflation combined with resilient growth and strong employment. Just as Taylor Swift could not have envisioned a Super Bowl celebration when she began dating Travis Kelce last fall, Fed officials could not have drawn up such an optimal picture of the economy when they first increased the policy rate more than 2 years ago. On the inflation side, some measures, including CPI, did print hotter than anticipated in the quarter. However, looking at longer-term rolling averages remains encouraging. And Fed Chair Powell himself suggested at the Fed's March meeting that, quote, "The story is essentially the same. Inflation gradually coming down towards 2% on a sometimes bumpy path." In terms of growth, 1Q data was less ambiguous. The economy is clearly on strong footing, helped by low unemployment, strong consumption, government stimulus, and a rebounding manufacturing sector. Given these factors, the Fed in March increased its 2024 U.S. GDP growth estimate to 2.1% from the prior 1.4% forecast. Below the macroeconomic data, the impacts of generative AI began to positively impact fundamentals in the first quarter, signs that AI is moving from hype to reality for many companies. A few examples from names held in our growth portfolios at Gabelli. First, NVIDIA reported a 5x year-on-year increase in data center revenues in the latest quarter, and Wall Street consensus now expects consolidated EBITDA this year to exceed 2022 pre-AI levels by 800%. Second, Microsoft disclosed that AI services contributed 6 points of growth to its Azure cloud business, implying this business is already annualizing at a several billion-dollar annual run rate mere quarters after launching. And third, ASML reported bookings nearly 3x greater than Wall Street consensus in the fourth quarter, due primarily to orders for extreme ultraviolet lithography equipment used to fabricate AI chips. The magnitude of these numbers indicates that AI is here to stay and will be a dynamic force in the stock market over the quarters and years to come. There will inevitably be some starts and stops along the way, but our overall view is that the technology is going to make the strongest companies stronger. And through this lens, we feel confident in our portfolio of the highest quality companies. So in conclusion, while there's no shortage of risks to the outlook, including potential lagged impacts of tighter monetary policy, geopolitical instability, sticky last mile inflation, and rising debt levels and debt servicing costs in the government, household, and corporate sectors, we are encouraged that macro and company fundamentals to date are strong. Therefore, we enter 2Q with a confident though measured approach to risk-taking, balancing reasons for optimism with discipline to reflect these risks.